freedom to you means freedom to whatever you want, right?
Yeah.
So your freedom could be, I don't have to worry about sending my kids to college. Your freedom could be one of the spouses could leave work. Your freedom could be we could start traveling. Your freedom could be I'm going to retire. And so until your money works for you while you sleep, you have no freedom. You're always trading your time for money.
Who's this? Oh, you're an entrepreneur? Oh, you're a real estate investor. Oh, you're trying to learn from those who did it. Well, come into the lab then. Put your white coat on, gloves on, notepad, and let's build, y'all. Experiment Nation, in the lab with Ruben, Kanya. We are back, guys. Rebranded as you know it. Remember, you're only one experiment away. And my goal with the In the Lab rebrand is to bring you different paradigms into the lab. And as we know, a paradigm is a multitude of ideas fixed in the subconscious mind. And the reason that's important is I want to bring you guys new insight. I want to bring you new insights from different walks of life, whether it's real estate, whether it's lifestyle, whether it's people from just different areas. I want to broaden the experiments because, as you'll see with this next gentleman who stepped in the lab with us, there's always fundamentals, core principles that are applicable in anything that you want to do. And there is always a common denominator to success. And my goal is to bring that to you in the limelight. So with that said, we just had Trevor Thompson step into the lab with us. And again, very different background, very similar to the types of individuals I used to interview. Multifamily syndicators is kind of how we started, and it transitioned. We had some business, and then we got heavy into the short-term rentals, and then we got heavy into midterm rentals. So my goal is to take you through my journey, and what I'm experiencing, who I'm rubbing shoulders with. So this gentleman, we actually made sure he was going to come with receipts because we're tired of having people come in and talk high level. We want to lift the hood and get behind the scenes. And I think we did get just that. So I appreciate Trevor for giving us this time because we have to drill into these things. Now, one of the things that stuck out to me in this episode. So Trevor Thompson is the vice president of Massive Capital, where they simplify multifamily investing for busy professionals to create generational wealth, which you've heard of. Essentially, he's a syndicator, and he's part of a group where he focuses on the education side. He focuses on essentially bringing in new blood so that people can put their money to invest passively with the firm. Now, what's interesting is he did join this group. Originally, he told me about his journey. It's only been 6 years ago. I think he said he started doing this when he was 58. So it's just fascinating for you who's listening that you can start a new experiment. Doesn't matter the time, right? You just need to be committed, and you need to do the following that he says. He talked about how studious he was. He was going on webinars. He became obsessed. I often hear that with people who come in the lab here who have gotten extraordinary results. One of the things that I'm blanking on his name now all of a sudden. Steve Harvey. One of the things that Steve Harvey says is, if you want extraordinary, you put extra in front of ordinary, right? Most ordinary people are not willing to be obsessed, right? Be obsessed or be average, right? So he got obsessed, and that's usually what it takes. He started to just study this whole multifamily thing. He started late, like he said. He got obsessed. He was on every webinar, every week, consuming. And what happens with them? He studied the medium he was going to go after. So regardless of whatever experiment you're trying to do out there, it's about studying the material and becoming a student of the game. I'm still a student in the game, right? Like I'm constantly learning and surrounding myself with people who are doing the thing that I want to do, right? I was just on a mastermind call yesterday asking questions because there's always an area where yes, I am a coach in the area that I specialize in, but there's tons of areas that I'm getting more consulting in. I'm part of a social media mastermind. I'm part of a business credit mastermind. I'm part of a mindset mastermind. I'm part of, you know, a mid-terminal mastermind that is aside from the one that I host. Like, there's so much value in continuously being a sponge, because you change your paradigm, you change your life. And so he was a student, and he studied a lot of other what is called syndicators. And in real estate, in multifamily space, syndicators essentially gather a bunch of money, usually 50K, 100K, 200K, it doesn't matter, whatever, whoever is willing to expend. But there's typically, you either have non-accredited investors or accredited investors, 506B or 506C. There's a lot of different ways you can raise capital with either sophisticated investors or some that are non-accredited. There's different regulations for that. But essentially, they collect all this money, they invest in these big multifamily assets, they do value add, and then in 3 to 4 years, sometimes maybe it's 4 to 5, or depending on the timeline, they give the investors their money back and then some. But during that time that these investors investing with them, they're giving out distributions, sometimes quarterly, sometimes monthly, depending on how it's structured. So what he highlighted that was very interesting, what Trevor highlighted, was that this is truly passive income, which he makes a strong case for. And it is true that it is passive. This is not like you actually need to take action and do things. This is you have a job, maybe you have a business, and you're taking this money and you're having someone completely run with it and get your returns. Now, you may have heard, right? We've had a lot of Airbnb people, we have midterm rental people. That is not very passive by any means. You're in a hospitality business, but the returns are, in from what I'm doing the math, can be greater. So, do you want to learn a skill where you actually do have, if you create systems in place, which is my argument, which most people are not willing to, but um if you if you set up systems in place that allow you to then essentially get more higher return on your time and energy, right? Like, we leverage our cleaners, we leverage our handyman, we leverage our automations in the technology space, but there's still a level of involvement. And I think that's the point that he's making. There's still a level, you have a pulse, you have to have a huddle, you have to have a touch point. It is a lot of work, but it doesn't have to be a lot of work if you have systems in place. It doesn't have to be overwhelming work, but it can be a higher return, right? For example, you spend 2 to 3 hours a week on it, and you know, in a year, make what he is willing to make you in 4 years by not doing anything. So that's what you need to do, is understand what's most important to me. But I appreciated him highlighting that, because we often hear it. One of the things that he talked about too, that I want to talk about, is the criteria, right? I think one of the things that is so important, he talked about him studying his criteria. So when he got on all these webinars, these sales pitches, because he's a limited partner, he's been a limited partner in like 20 deals passively, and or don't quote me on this, I say, and when I went and get into the weeds of it, but essentially he's done this in volume, and he's been both a limited partner and a general partner, where he's involved actively. So you're hearing it from someone who's done it on both ends. And what's interesting is his whole thing when he was studying, which I really appreciated, was the criteria. He got very clear on what made sense, whether it's going to be an A, B, or C class neighborhood. He knew exactly what his buy box was, which is very similar to what we do in midterm rental insurance spaces. Whatever space is, speed is going to be based on how quickly you can make decisions. And most people struggle with making decisions because they don't have a criteria in place. They don't really know what they're looking for in a deal or in their lives, for Christ's sakes, right? So it's really important that you understand what your buy box is. In this case, he understood what his criteria is. Now, one of the criteria that he used as a limited partner was a who, what, and where. Who is actually operating the deal? What are they actually bringing to the table, right? Like, and he says if there's anyone who says they can do their changes and value add in 18 months, it's just a hard no. He walks away, because he just knows that's part of his criteria, like vetting the operator. What is the operator actually saying, and where are they investing? He even used the analogy that I love. He bets on the jockey, which is the who, the horse is the essentially the asset, right? The asset type, and then the you know, the environment that the horse is in is the where. Like, what market are we in? Have they had experience of that market? Do they manage in that market? You know, like that, all that matters, which I really like because he really broke it down. Another thing that I really liked, he broke down internal rate of return, which is pretty tricky thing to understand, but the way he explained it, if you put in 100K and you know you get 30K in cash flow during the life of, like, let's say 4 years, 4 to 5 years, call it, and then when you exit, you get another 70K essentially from the appreciation, then now you've doubled your money essentially, right? Because you get your principal back, the 100K, you get it back, then you made 30K in cash flow, and then you made 70K on the upside. So they had that, he said, is close to like anywhere from like a 17, I think he said anywhere to 20% IRR, internal rate of return. That's a nice I think breakdown. And what I also did appreciate is he broke down the 20-year kind of, or like if you were to invest for a 20-year cycle, how you would do 100K, then you do 200K at the end of those 4 years, then you took that 200K and then you did another 4 years, then it would turn into 400K, and then you turn that again 400K, and then he just showed the progress of how doubling your money actually works and how you could actually passively, again, in 20 years or so, have, be in the upwards of 1.2 or 1.5 million-ish area, which again just shows you the trajectory of the compounding effect. But again, it's good for you to know this information so you can make a decision, keyword decision on what strategy you want to use. And if you hear that and you're like, oh, I'd like to focus on my business and continue to invest as a syndicator and double my money every 4 to 5 years, again, it's all relative to the amount of money you put in, then you have that as a receipt thanks to yours truly here. But if you're like, no, I think I can roll up my sleeves and I can, again, people have done it. I think this is why I love the short-term rentals / mid-term rental area, because there's a lot of stuff like cost segregations, forced depreciation. There's that in passive investing as well, but I guess it's like a pass through, and I'm not gonna get into that because that stuff gets really complicated. But in short, you got to look at which one are you willing to do, right? Do you want to roll up your sleeves a little bit with the right systems in place where it doesn't have to take that much time? That's why we love the midterm rental insurance space. We just had a 10-month contract. Very little to minimum work. We don't hear from the tenant, but we're getting the same premiums, if not actually more than what Airbnb would make, because we took the time, again, to invest in ourselves and learn a structure where we work with temporary housing companies who are willing to pay us a premium. But again, everything works if you do the work. You just got to know what is it that you're looking for. So the passive versus active was an important key takeaway. The who, what, where was an important key takeaway. The internal rate of return. All those are really, important things that you need to know with respect to the direction that you're going into. And just like that, of course, I'm bringing in someone with different background, different strategy, same principles. I would say being obsessed, focusing on a who, what, where, who, not how, and being studious, being obsessed with education so that you can make the right decisions to then get the rewards. And I think one of the things I asked him, what's his goal? He wanted to have 10 million in net worth, and he's on his way. And he started this 6 years ago at 58 years old. So if you're listening to this, power to you. You're probably there's a good chance you might be ahead of the game, just knowing where my audience is. Maybe you are 58 and you're listening to this, or older, but there's a good chance if you're listening to this, based on what my analytics show me, that you're not. And so what can you do today, and what does your compound effect look like? And what experiment are you going to go and be obsessed with and go deep on so that you can have speed to market and make decisions and be efficient? Those are the kind of principles that I want to bring to the limelight. With that said, now have a look and listen, a very close listen, to the amazing gems from this episode. Real estate experiment. What is happening, y'all? Today we have another expert that is, again, very niched, and I'm very excited to talk about this gentleman who's accomplished a lot on the real estate side, of course, but has a very interesting background when we think of when we think of
what he brings to the table as a real estate investor. And with that said, he is not only dialing from Austin, Texas, but he also has receipts to show where he's invested all over the state and then some, and has a background as a vice president of a very interesting company, which I'm very interested of hearing to see how, what happened first, and if he's actually taken some of the skill sets we appreciate here in the lab to transfer over to his real estate investing. So without further ado, I want to introduce Trevor Thompson with, again, government name Keith the Jr. But Trevor Thompson here is in the house with us of massive capital. And first of all, welcome, Trevor. How are you doing today? And
I'm
where are you
awesome.
dialing
I'm
in from?
excited to be here. Thanks for having me.
Absolutely. Like I was saying, it's a little bit overdue. And so I want to say thank you for being patient. And now we're officially in the lab. So we're glad to have you here and undergo and understand the experiments behind all of the experiments now that you're in the lab. So let me ask you. So Trevor, you introduced yourself. You told me about, kind of the name, the K, not to be mistaken for, Trevor. You go by Trevor Thompson. Let me ask you, if you and I were connecting either at a meetup or, running, I love to travel. So if I run into you at the airport and ask you, hey, what do you do for a living? What comes first?
Yeah, so I always tell people that my goal is to help 1,000 people reach financial independence through real estate investing. And that's pretty generic, opens up the door to what does that mean? How do you do that? And often they ask how many people, and to be honest, I haven't started counting, so probably a mistake on my part. I should have paid more attention.
That's right. Well, it's kind of a domino effect, right? Because if one person listens, takes actions, but doesn't ever let you know from by just listening to the show, that's another person that you don't really get to track. But I love the intention. What's the Tell me, how'd you come up with 1,000? Why a
You know,
thousand?
it was funny. So I started with 100, and then I listened to Grant Cardone's 10 Exit, and I went to 1,000. And realistically, 100 is pretty low. You know, I probably have about 100 people now that have invested with me or through me. And so it was just kind of a number that sounded big, but was still achievable.
Okay. What would need to be true to make it 10,000, do you think?
You know, I'd have to get a lot more deals and probably start to be a little younger.
A little younger. You're as young as they come.
Yeah.
So Trevor, let me that's interesting that you said a lot more deals, because it doesn't sound like, based on what you said, uh, there's a shortage of folks who want to invest with you. It sounds like it's more of the deal flow. Is that right?
No, so we definitely have decent deal flow. You know,
Mm-hmm.
I start with a lot of people that are new to investing.
Mm-hmm.
So there's a long education curve, right? Because they just don't understand, they don't get it, they don't quite understand it all. So I spend most of my time educating people, and just talking about what does that mean for you. And, I always start conversations talking about the great Warren Buffett, who said, if you don't find a way to make money while you sleep, you will
Mm.
work until you die. And then I talk all about the power of passive investing. We all know about leverage in commercial real estate investing. And then I go through to the compounding of your earnings, which is, to me, to be honest, is the most powerful, why you need to start early.
Mm. So you're taking are we saying a non-sophisticated investor to begin
That's
the journey with you?
or generally just low sophistication and trying to help them get educated. Don't get me wrong, I talk to everybody, but the
Right.
majority of the people I talk to are, I saw you, I heard about you, I learned something, you know, tell me a little bit more, right? So they may have bought a single family home, have a
Mhm.
rental, or have done some other things, but a lot of the people, I would say, close to half of the people that have invested with me has been their first time passively investing in a real estate deal, which is pretty large. Now, I have one person who's invested 5 times since her first one. And so that's also great for her and great for me. But I do have a lot of first time people, and I like to be patient and teach them, how powerful it can be and how it can change their life.
Okay. So let me ask you a very important question. And this is where I hope we can build a foundation on this, right? Because you mentioned Grant Cardone, which is someone I admire as well. And I've gone to his 10x Growth Con, read his 10x book. So you always go bigger. Grant says something interesting. He kind of says, he started out with a single family, and but then he did something interesting. He realized that again, he got into sales, then took all that sales money and bought a multifamily, and then it kind of just snowballed from there.
Yeah.
And then he, obviously now he has more than 4 billion assets under management, and he's doing it at scale. Now, my question is, and I'm curious what your thoughts are on this. You talked about working with, non-sophisticated financial, sorry, non-sophisticated investors, right? Or at least, just in the beginning phases, maybe
Yeah.
maybe they have
So,
one, maybe
I
they
would
have
call
two.
them non-accredited that I make.
Non-accredited,
They're
yes,
non-accredited
yeah,
and I make them sophisticated by educating them.
yes, love that.
And so a sophisticated investor is really somebody who has some education, has some been
Hmm.
spoken to. You've been clear about the risks, you've been clear about what happens, what their role is, and they become a sophisticated investor. And again, I often connect with people that are very early in their journey. So
Yeah,
it's not like I find somebody at the grocery store that doesn't even think about ever doing anything, doesn't even own a home. I'm
yeah,
mostly talking to, people that are at a stage at their life where they're ready to start having their money work for them versus them work for their money.
yeah. Well, I guess the best time is yesterday,
Yeah,
right?
always.
Right.
No
So,
one
so
ever says, I wish I'd have started later.
100%. So
Yeah.
here's my question, because you said two key things. You said financial freedom, which I love. What does financial freedom mean to you? Why don't we start there? And what do you think it means to what should we be striving for?
Yeah.
Again, yeah, let's start
Well,
there.
the beauty is there's no one answer.
Hmm.
And so what does it mean to you, right?
Yeah.
So everybody's at a different stage in their life. But what I like to talk to people, just imagine this, okay? You're 25 years old, you've been working hard and you've been managing to save $100,000. And
Yeah.
you invest that $100,000 into a real estate syndication and you double it in 5 years. It becomes 200,000. Now you invest it again, and in 5 years it becomes 400,000. You invest it again, in 5 years it becomes 800,000. You invest it again, and it becomes $1.6 million. You invest it again, and it becomes 3.2 million. This is assuming you always double your money and you have no tax complications.
Mhm.
What would that do to your family where you started with only one investment of $100,000 and you let it compound? Just think about that. It
Yeah.
grew to be $3.2 million. And I always tell people, would that change your family's financial future? And obviously the answer is yes, it would, right?
Yeah.
And so again, I didn't start investing in real estate till I was 58. Okay, so
Mm.
I'm always on this mission, man. Start, and again, 100,000 is a lot of money. Leaving it invested is a lot of money, but I'm only talking about growing one initial investment.
Mhm.
That's what it, and then of course freedom to you means freedom to whatever you want, right? So
Yeah.
your freedom could be, I don't have to worry about sending my kids to college. Your freedom could be one of the spouses could leave work. Your freedom could be we could start traveling. Your freedom
Yeah.
could be I'm going to retire. And so until your money works for you while you sleep, you have no freedom. You're always trading your time for money. And
Yeah.
so to me, freedom means that you have choices. A lot of people, I loved my job. I got let go with COVID. I might have still be working today if I didn't, because I loved what I did.
Mhm.
But I wanted the freedom to make that decision, right? And to me,
Mhm.
that's what freedom is. And freedom is to be having your money work for you versus you work for your money. It's plain and simple.
Yeah.
And to everybody, it's a different thing, right? Some people, I would just like to have one person stay home and take care of our kids. Another person is, I want to make sure my son can or daughter can go to college. Everybody has a different definition of what makes them free. And my mission in life is to give them the financial tools to be able to make the choices that suit their what they want.
Yeah. So I'm so glad you went there because I'm straight to the numbers, right? Like you said, 100K again as a great example. In possibly in 4 years it doubles. Then in another 5 years it could double, right? And
Yeah.
now you see a compounding effort, kind of roadmap. So let's just say that was 3.2 million. That would be over a span of what?
Well,
Call it
3.2 million was 25 years, assuming you doubled it every 5.
yeah, yeah.
So
So that's about
again,
25
that's a
years.
lot of money.
It is, yeah, it is. I guess my question for you is as follows, and I'm curious to hear what your thoughts is, and I would almost want to uh hear it the same way I would ask probably Grant the same question is, um, so as this you know, raising capital, I want to look at both ends, right? Because there's you have your experience as a GP and LP, and when we think of wealth, we think of also speed, right? So if we put that side by side, can you just help debunk, or maybe it's a limiting belief because maybe someone's thinking, and maybe they are, maybe there's no right or wrong, but I just want to put them side by side. If you're investing in a single family, etc., what's the case study against, I do a single family, then maybe I build some equity and then I buy another single family and then, now I have two working for me and now I buy another three. Are you suggesting that perhaps this is more for someone who, hey, this will fast track your path, or it's more for the person who doesn't want to roll up their sleeve and say, you know what, I don't want to buy I don't want to play Monopoly and do the single family. I want to continue to work on what I'm working on and then have my money work. Like, what's the case study for? Can one
Yeah,
have
yeah.
both?
So
Do you see one is more effective than the other? I want to kind of open up the hood
yeah,
here and have a look
yeah.
at this
So
financially.
what I always tell people, and again, a lot of people I talk to, they've started with single family. And I
Hmm.
actually want to tell them, I want to make sure that they understand they actually bought themselves a job. They didn't invest money. They bought themselves a job. They have to fix the property. They have to rent the property. They have to do all of these things. And they've set it up in a structure that is very high risk if you're not in a high appreciation area. In other words, if you only have one home and the tenant trashes the home and it takes you a month to fix it, a month to lease it, you still got a mortgage payment. So
Hmm.
again, don't get me wrong, a lot of people have done well and it's a good place to start, but that is buying yourself a job. That's not a passive investment. That's an active investment. Where what I'm talking about is taking your money and giving it to somebody else who has the job to do it. And they do all of the work. So on a syndication, we buy the apartment complex. We have the scale. So we have, 100, 200 units. So if a couple of tenants move in and out, we have professional property managers. We have all kinds of things. They're not going to get a phone call at 11 p.m. at night saying the toilet doesn't work. They're not going to get a call from the neighbor that say your rental house is on fire.
Hmm.
Me as a syndicator is going to get those phone calls, or at least our property management company will. So again, I'm not saying starting with single family is wrong. I'm just
Hmm.
saying if you're looking for a true path of passive investment, investing in commercial syndications is true passive investment. You give someone else the money, they do all the work, they take all of the risks, and they share the rewards with you.
Mm. Okay, that's very interesting, and I think I would agree that um same thing, and we've had a lot of short-term rental operators who have come into the lab, and or AKA Airbnb, and Airbnb is more arbitrage, but it's really you're in the hospitality business now. And so, I hear what I'm hearing you say is, there's different types of models. For example, I know fixing, flipping, that's a full-time, like even you
Yeah.
get taxed differently, right? Because that is a job for sure, right? Uh, you know, I would only argue, and I'm curious what your thoughts are on this, Trevor, because it just came to mind. An argument could be made that on the single family side, if you had management in place, the only thing I would say now to debunk my thought as I'm saying it to you is like, well, your margins get eaten up and it's smaller
Yeah.
margins on long-term rentals. But would you agree that maybe that could be a form of passive and you're making the the case that it's just not going to take you as far as multifamily would?
So it's passive as long as it works. And the
Mm.
second it doesn't work, it's not passive. The second there's no tenant paying your mortgage,
Mm.
you're now paying the mortgage. The second something goes wrong with that model, okay, Airbnb, some neighborhood restriction comes, you got to go to 30-day rentals instead of weekly rentals. All of those things happen. They can disrupt your path. And then when it disrupts your path, all of the risk gets transferred just back to you. So again, you could have, man, you could have I've got a friend, he had a single family home for 8 years, he had the same tenant. And then they left, and he's gone through 3 tenants in 1 year where he's had to evict them. They've trashed the house. He's cash flow negative. So he's spending his paycheck to get cash flow back. That's all I'm saying is passive investing eliminates all of those risks. Doesn't mean it's a quicker path to financial freedom. Because again, I've got a friend, he's got 130 rental houses, and he's the machine, and he's got a system, and he knows how to buy them, and they fix them up. And he's done super well. He's a multimillionaire now. He's done it well. Now him and his partner do it full time. But they have such a large portfolio, they hedge their bet. But if I have one rental house and I can't find a tenant at a rate that pays my mortgage, and especially nowadays with high interest rates and different things, home ownership is getting, the 1% rule doesn't work on a $300,000, $400,000, $500,000 home in most markets. And so I'm just saying that passive investing, while not perfect, there's still things that can happen. Passive investing is, a lot, just the risk reward is changed, it's altered.
Yeah. Experiment Nation, you've heard the word MTR, mid-term rentals, as it is currently a hot topic and hot commodity right now because, again, there has been an increase in short-term rental regulations, and there also has been, let's face it, a slowdown in what we were experiencing a couple years back when it comes to bookings. So with that said, short-term rental operators are looking for alternative solutions to tap into the mid-term rental space. However, there is a sub niche of mid-term rental insurance that I'm truly excited about, that I want to share with you, that the experience that we've had, the tremendous results we've been able to have, and that's the insurance mid-term rental space, which is very different than your traditional mid-term rentals. When you think of traditionally mid-term rentals, you think of travel nurses. There is a space, mid-term rental insurance space, that we've tapped in, where you need to be well connected with insurance and relocation specialists and companies and understand the right type of asset required for you to be able to help these families. What's really important that stands out the most, which you can get in what I'm about to offer you, is the understanding where to be found by these insurance companies, how to properly manage your calendar so that your listings are optimized so that they can find you, how to actually gain traction and build a relationship with these relocation insurance companies. I've put together an MTR insurance blueprint. That's MMTRRR insurance blueprint to cover these foundations after we've had success landing very large contracts on single family homes that literally 4x what we traditionally make in long-term rentals, and also gives us peace of mind because there's less turnover and 100% occupancy, because these contracts can start anywhere from 30 days to 3 months to 8 months and range anywhere from, again, we've landed anywhere from $8,000 to $9,000 a month per month on a single family home property, which our mortgages are typically around the $2,400 range, which then gives you a large spread of anywhere from 4 to 6K net on just one property. And this is why it's very hot right now. But people who haven't been in the lab with individuals like myself, like Jesse Vasquez and Dr. Rachel Gainsborough and Noble Crawford, don't have the foundations and don't know exactly where to start. And therefore, this is why I'm giving you guys a blueprint, the MTRR insurance blueprint. Go to the website, experimentrealestate.com, and get yourself a blueprint to completely change, or at least have a plan B if you're a short-term rental operator looking to maximize your occupancy and profitability. We'll see you on the other side.
No, I'm so glad you called that out. That's a really, and this is what I was asking you. I thought you'd be able to provide some good context here between the difference between true passive, because a lot of people say passive income. Oh, you're making passive income on, let's say, a single family or even an Airbnb. But was it really passive, or is there work involved? Or what I hadn't heard before, which is very interesting, is it's passive until it's no longer passive, right?
Yeah.
And so what you're saying is you're offsetting that risk of by investing with
Well,
essentially professionals.
everything is a balance of risk
Yeah.
reward, right?
Yeah.
And again, unfortunately, the world has changed where buying a single family home and renting it out, the kind of numbers are out of balance, right? Because the mortgage rates are high, the house prices are high. So unless you have some sort of unique situation and then you're in a market that has a lot of rental demand, that's all I'm saying. Doesn't mean you're not going to be successful. Like I said, a lot of folks are very successful. And even on the multifamily side, I get a lot of friends say, well, I'm going to go buy a fourplex or an eightplex. And I said, that's great. As long as you understand you're buying yourself a job, it may be a very well-paying job and it may build your net worth up quickly. I'm just talking about the difference between true passive investing and passive income.
Okay. Yeah, got it. So tell me, because you've done a little bit of both. You've been a limited partner as well.
Yeah.
So AKA passive investor. And now, of course, you put yourself in a position where you're able to help those become passive investors with you. Am I correct?
Yeah, so I started out as a passive investor.
Mm-hmm.
I was about 12 passive investments before I did a couple of active deals. Overall, on my whole 6 year in real estate investing, I've been a passive investor on 20 syndications. 8 have gone full cycle, and now I'm an active sponsor on 12 syndications. And all of those, I'm part of a bigger team, and my role on those teams is bringing in passive investors so that we can do the deals together.
Got it. So let's talk about the first 20 that you did passively. Talk to us about, because 20 is a lot. And we were talking about this case study of 100K, etc., right? Which was just a case study on its own. Tell us about that process. Where were you at in your journey? Did you have, money sitting in 401k? Did you have money sitting in savings? Did you sell a couple of assets? How did you break into your
Yeah, so I
first
was really
limited?
lucky. So in my previous life, and I was always interested in real estate. So let me even go back further. I was interested in real estate, but I was terrified of toilets, tenants, and trash. And I still am terrified of toilets, tenants, and trash, which is why I didn't start doing the single family route. And then to be honest, I had a misconception to get into the commercial route that I needed to be a millionaire. So I used to think, okay, I got to be a millionaire to be able to do this, because commercial real estate, we're buying $10 million, $20 million apartment complexes. That's a fallacy. That's wrong, but I believed it. So I actually worked for a company called I Fly Indoor Skydiving. We got bought out by private equity, and lo and behold, I got my big payday. So I had this money. So I stuck it in the stock market, and I kept thinking to myself, I know I got to get into this real estate game. So I actually went to a couple of weekend seminar type places, and I went to one that talked about multifamily syndication. And I went, I completely understand this business model because I've done it in business my whole life. Because you have to remember what a syndication is. You actually are buying a business that operates out of an apartment complex. You're bringing in investors, you're bringing in money. So it's like you're buying a business and you're fixing everything that's broken on the business. So you're adding some capex to make the place look nicer. You're adding professional management. You're adding professional marketing. You're doing all of these things, and then you increase the value of the business, and then you sell it for a multiple, which is the cap rate of your net operating income. And I went, oh my goodness, I had no idea this existed. And the simplicity of it, right? Because a lot of people think, well, we're buying an apartment building. We're not. We're buying a business that is based in an apartment complex. or we're building a business. The case we do some new build retail. We're buying a piece of land and we're building a business, and we're not selling the bricks and mortar. We're selling the whole business operation. So when we sell an apartment, we're selling an operating business that happens to
100%.
operate out of an apartment. When we build a new retail, we're taking nothing, we're buying land, we're building a retail, we're renting it out, and then we're selling it to somebody who wants a finished product. So it's a different kind of business model, but when I understood, oh, that's how it works, and I also understood my only risk is my investment, right? So again, if you have a single family home and something happens and insurance and, you've got a lot of responsibilities. And I wanted to have I wanted to give somebody else my money and they had all the responsibilities.
Yeah. Did Trevor, did I'm just curious because when you were talking about, essentially buying a business, which is 100% right. I was thinking about the operations behind the scenes. You guys, in the beginning of those first 20, did you see a common denominator where they were taking the management in-house, or were they leveraging third parties? Do you
So
recall?
every deal that I was on had third-party management. On the multifamily side, retail, so they bought an existing retail and fixed it up and they managed the property there. They had a property management company, so they collected the rents from the tenants, they leased them out, they took care of the property. But all of my multifamilies have third-party property management.
Got it. So you basically started, this is very interesting to hear. Did you was this around COVID when you
So
basically
I
got a
started in
package?
18. I started in late 18, started my
Oh,
real estate investing career. And then I invested, I've been investing ever since.
wow. That's a pretty love the all that you've done in that window of just over a half a decade. So I'm curious, for someone who's listening, like yourself, you got a essentially, private equity bought you out with the company. You're, I think, a vice president there, right? Is that right?
Yeah.
And were there shares, or where did you
Yeah.
see?
So we had an ownership share and I actually still stayed to work there. They ended up screwing it all up, which
Oh, wow.
didn't help. They actually ended up walking away from it, giving it back to the bank. And then COVID really did the company in and they just laid everybody off. And then a new buyer
Wow.
came in and bought it. So that's a whole different story. But yeah, and so I just I was always interested in real estate. I just didn't know what my path was because I
Yeah.
didn't want to do the single family. So, and
Yeah.
I may be jaded in all my conversation because I just don't want a tenant calling me. I don't like it when my wife tells me my toilet's not running. Why in the world would I want to make that a business, right? My toilet, keeps running. I just don't want to make that my business. I wanted to be able to do it. And then I found this role of being able to be part of a team, helping other people achieve their financial freedom goals by bringing them in. To me, it was just like dream job landed in my lap.
Yeah. Trevor, tell us about the because I think it's important that we cover the journey from an LP, and then doing 8 full cycles, and then going into 12 syndications yourself as an active sponsor. Those first the 20, did you say, okay, I got a good chunk of money and I'm gonna now diversify across a bunch of different I'm going to
Yes.
be an LP across a bunch of different. Can you tell us about that? And then if you could as well, what was the entry? I hear sometimes 50K, I hear 100K. Is it more
Yeah.
than that? Tell us about your mindset going into this, about I just learned something new and I don't want to buy myself a job. Here's the next strategy for me.
Yeah. So the majority of my investments were multifamily apartments, but I did all different asset classes.
Mm,
So there's apartments get A class is the nicest luxury places where people live. Then there's B class, which is, kind of built in the last 30 years and it's a
hmm
nicer place. And then there's C class value add. So I started investing in C class value add, where you're buying a product from the 60s or 70s, you're spending some money, you're turning it around, and you're doing that. I've also invested in They bought an A+ property off a developer, and I've invested in an A+ new build. And the reason I wanted to do it, I wanted a little geographic differences. So most of the original ones were in the state of Texas, one in Tucson, but I wanted to buy a couple of asset classes. Just once you start investing a lot, I wanted to get a bit of diversification. And then I did a land development deal, a retail deal, and a new build storage. And how I did it all was who you invest with is the most important factor. So I would start looking for the who's. So for example, there was a group and I wanted the who, what, and where. So I wanted to invest with this group. I wanted to invest in new build storage, and I wanted to invest in North Carolina area because it's really growing. And so I actually passed up 3 deals from this group. And then all of a sudden an email comes across. It's that group. It's a new build retail or new build self-storage just outside of Charlotte, North Carolina. And I went, oop, all 3 buttons checked, literally watched the webinar, looked at a few documents, and I invested. And it was just a, you know, because I had already decided that's kind of what I wanted to do. But at the beginning, and still, I would say 70% of my total portfolio has been multifamily, and probably 60%, 70% of that has been the value add. So a lot of value add multifamily. But I wanted to get into some different asset classes and some geography. So mostly in Texas, because I'm based here. One in Tucson, Arizona. I've done 2 investments there. North and Denver, Colorado, because it's a great place. And North Carolina and South Carolina and Georgia. So those are the places that I've gotten on. And then near the end, when I joined up with Massive Capital, basically they were finding the deals and then I was finding the investors to help close those deals.
Yeah, which we'll get to in a second, but I want to get to what you just said. The who, not how is, again, a phenomenal book, which I'm by Dr. Benjamin Hardy. Like, I love how you said who, what, where. Tell me about where did you get, I have 2 questions there, as a matter of fact. One is, where did you get the insight that you should diversify? Because we always hear there's, you know, I feel like this is almost like a micro niche within the niche, right? It's like, okay, go into syndication, become a passive investor, and then there's all these other doors, right? You know, there's storage, there's, you know, there's retail, there's new build. What gave you, coming in as a, I would say, a new investor, where did you get the foundation and the insight, or maybe just the knowledge to think, you know what, if I'm going to do this, I'm going to make sure I'm going to spread it out across maybe these different type of asset classes?
Yeah, so I originally joined a mentorship program, and I joined it really looking for a group because I wanted to be part of a group where I could say, hey, Ruben, what's going on with my deal? We're at a meeting together, right? I can go walk up to you and go, hey, what's going on? So I wanted a group that I knew the people. So, and they were doing multifamily syndications. I invested in
What's the group?
It was called Phil Grove's Big Dogs. It's a local Texas group. There's lots of real estate groups, but I was looking for a place, and so that's where I got educated, and I started to learn, and then I became obsessed. So I mean, I literally listened to millions of, probably not millions, but hundreds of podcasts. I was going to 2 webinars a night. I was looking at deals, like just trying to get some idea, and then I would just kept absorbing information and thought, oh, that's a great thing to learn, and let me learn more about that, and let me learn more about that. And so I became very obsessive and very self-taught. And you know, and that's, I like to share what I learned with other people, which again is this great niche where I like to help people that are new and try to understand it.
Got it. And so you get this mentorship, you figure out the who, which I love because I'm a huge fan. The best investment you can make is in yourself. You get the guidance, you get the blueprint from someone who's already done it. You're also diving in deep, be obsessed or be average. And you're going in there and now you're saying, I'm gonna have different asset classes within my investment criteria, which is another thing too, that is, you know, people sometimes fail to even, you know, what allows you to make very effective and decision and speed is by having a reference point to be able
Yeah.
to go back to. And I talked to a lot of investors are like, is this a good deal? Well, it's like, well, what's your buy box, right?
Yeah.
And it sounds like you were very clear on what your buy box was with the investment yourself that you did. The
Well,
question I
and
have,
again, I
Mhm.
was and I wasn't, right? So,
Okay.
but I knew kind of what I was looking for. So I also like
Yeah.
to do an analogy of the jockey.
Yeah.
Jockey's the who, the horse is the asset, and then the track is the where. And so you
Oh,
want to
nice.
pick the winning jockey on the winning horse on a track that suits them, right? Because some horses run differently, and I'm not a horse bet or anything, but that concept of I wanted those three things to align for me. And I also, again, I'm mostly invested in multifamily because I'm the most educated in multifamily, I have the most experience in multifamily. And I also believe that a lot of people need houses to live in. There's never been a bigger delta between rent payments and mortgage payments in the history
Yeah.
of America. So it's just going to get better and better. But I also wanted just a little bit of, especially when you get up to 32 investments, you want to make sure you have some diversification in your portfolio.
100%. So, speaking of those 32 investments, how many syndications did you start off with altogether? Was it one? Was it two, three, four? How many?
Oh, so I invested in two within 2 weeks of each other. And then the third one within 3 months. So I just kept looking at deals and saying,
Yeah.
okay, that one looks good, that one looks good. And, I probably looked at 100 deals to pick one. I was
Wow.
super, but again, every time I looked at a deal, I learned and why did I not like it? And,
Yeah.
but I also was spending my time looking for my who's, right? So, it's just meeting people and connecting with people and booking a, 15, 30-minute call and then start watching them on their podcasts or other podcasts they're on and then go to their deal webinars and just listen. And, and I listened to a lot. And in fact, my best investment to date was with a group that I followed for about a year. And about halfway through that, they talked about a deal that didn't go well. And they were super honest about it. And I thought, oh, I like that.
Is
A
that
lot
one
of
of the
people think,
things you
why
look
would you
for?
invest with somebody who didn't do good? Well, because they already learned all the lessons with somebody else's money, was my thinking. And, it would turn out to be my best deal ever. And I've reinvested with that same group right away. Literally, like the money showed up in my bank account at 10 and left at 11 in the next deal with them. Because
Yeah.
again, it
Yeah.
was successful.
Yeah. And I was gonna say, is that one of the things you look for when, or at least if someone's listening and they're like, okay, I got some capital, or I really like the idea of Trevor is talking about. I don't want to buy myself a job. I'm doing all this actually so I can have another asset that's working for me. I want to start getting on these webinars too. I want to start screening. What am I looking for? Because there's a lot of noise out there, social media. There's a lot of webinars. There's a lot of meetups. And mind you, and all, as we know, not who's are all created equal, right? What is
Yeah.
it that I should be looking for? What is it that I should be from a risk management, looking that maybe they're not mentioning and asking maybe that they're not calling out? Is there anything that
So
comes to mind from your
let's go back and let's talk a little bit about the who. I
Mm,
always used to, and again, I'm not going to date them. Is that somebody I would date? Is that somebody I'd like to have a 5-year relationship with? Do I
mm,
really feel like they're listening to me and hearing me and answering my questions and telling me the truth, right? So that's super important. We all look good. I look great on social media. It's amazing, how great I look, but I work hard at it. But what you want to do is you want somebody who will speak to you honestly, who will take your phone calls, who will answer your questions. And then when you decide not to invest in a deal, they don't just like, I'll tell you what, I looked at a lot of deals and then made a decision not to invest and just wrote me off, never called me again. And I'm like, oh,
mm,
it wasn't this time. Where other people say, I understand, you worked hard to earn this money and let's take a look at the next deal, see how it fits for you. And they
mm.
still talk to me in between deals. That's who I'm looking for.
That's great.
And
That's a great one, by the way. Thanks for sharing that, Trevor. That's a great.
Yeah.
advice.
Well, you want to make sure, right? And then did I like the business model? Do I like the people? Do I think they're not only going to make me money, but make the world a bigger, better place and are, just decent people? And then you got to get some education to be able to understand, are the expectations realistic? So for a while there were so many unrealistic deals out there. We're going to buy this apartment, rents are $1,000, and we're going to put rents up to $1,500. Well, you're crazy. How are you going to do that? And then you got to start looking at it and say, well, okay, what's the medium income in that area? Well, the medium income in that area can't afford more than, because you got to remember, they got it 3 times for their rent. They got to be making $50,000 and everybody in the neighborhood makes $35,000. Your business plan is flawed and you need to start looking at all of those things. And then, I was starting to see deals. Yeah, we're buying 200 units. So we're going to renovate all 200 units in year one. You can't do that because you can't renovate leases till they turn. And, as you get educated, you start, anybody who says they're going to achieve their business plan in less than 18 months, immediate delete. Anybody who promised too big a returns, we're going to triple your money, we're going to do this, we're going to do that, automatic delete, not interested. I want somebody who has a realistic business plan that has based on good information with fair returns, right? And I also like deals where our interests are aligned. So for example, a lot of massive capital deals, we do a 7% preferred payment, which means until you make 7% on your money, us as sponsors don't make any money. Then if we achieve a 17% IRR, which I know I don't know if your audience understands, but that's the internal time use of your money. The split is 70-30. But if we achieve greater than that, the split is 50-50. Now, a lot of my friends at the time were saying, this guy's want 50-50. That's ridiculous. I'm like, hold on, think of it now. I get paid first, and until I make at least 7%, they don't get paid anything. If they get to a 17% IRR, which equals about doubling my money we talked about, they're going to make 30%. If they do better than that, they're going to make 50%. So they still got to be better than the 17 IRR, better than the double my money. Why in the world wouldn't I bet on the jockey? Like, I want the jockey to go home rich and I want my money to go bigger. So I like this concept of aligned interest where we get paid first. And they call that a waterfall on the splits. I actually prefer those deals because I think it aligns interest and it also motivates the sponsorship team, right? Hey, listen, if we could just grind out another $1 million on this property, it's going to go to we're going to get 500K of that $1 million versus 300K, which is split between, and how many ever of us. That's a big incentive.
Yeah, 100%.
And then, so again, our interests are aligned.
So interests being aligned, anyone who's basically saying that 18, they can do something under 18 months is like definitely a no-go. Being realistic with the economics of the actual area that you're investing in, making sure that, hey, like if you're gonna actually 1.5x the rent or whatever, double or whatever that number is increase it by 50%, does that actually make sense, and does that align with the economics and the job growth or the job, what people are able to afford? Those are any other things that the key takeaway. I know this could be an entire masterclass, but is there anything else that jumps out that you would say, hey, please be on the lookout for this as you start looking at deals, because it's going to take reps, and so I'm sure there might be a thing or two.
For me, they have local experience in the area. So again, that deal, that my best deal ever, this was their 6th deal in the area. They currently they knew that market. They'd been there. They know the market. There's a lot of people out there saying, well, I got a deal in Kansas, and who lives in Kansas? Nobody. Well, who's going to take care of the property management company? Well, hold on a minute. I want to know that somebody on the sponsorship team understands that market, can be in that market, knows all about it. So for me, boots on the ground are super important. I want to know that there's somebody on that team. I live in Austin. I can tell you what subdivisions are good, what areas are good, what's going on. I want that local knowledge. That's why I'm trusting you with my money.
Are you suggesting, Trevor, that having a third party management company that is from that area might not suffice?
So third-party property management is a babysitter.
Mm.
They are not the parents. The people who are doing the deal are the parents. The property management company is the babysitter. Babysitters are great, but you can't leave them unattended for years on end with your children, which is the money that's in that deal is my
Well
children.
said. Well
So
said.
again, property management company is a babysitter. And to be honest, their job is to do as little work as possible to achieve the greatest return. As an owner, as a sponsor, as a syndicator, my job is to do the best job for our investors. And if I'm aligned, I get paid after my investors get paid, I'm getting paid too. So a property management company, super important, bring a lot of value to the table, but they need to be managed, which is what with the general partnership team, whoever's on the asset management team, it's their job to manage the managers. That's why every business has a manager, right? They don't have a manager that's never there, you know. You go to McDonald's anymore, it's run by kids, right?
Yeah.
I want to know there's a manager there making sure,
Yeah.
and so local knowledge is super important.
Yeah. So this brought us full circle with the who, because originally when I asked you, said let's take a step back and let's focus on the who, which I think is who, not how. It's so important. Betting on who is the jockey,
Yeah.
and do they have a good hold? And even if they're solid, it sounds like you're even doing due diligence. Okay, great, you've been solid in Texas, but now you're trying to take us to Ohio here. Let's evaluate the horse and the environment, right? So it sounds like there's I like how you said who, what, and where as those
Yeah.
foundational pillars anytime you're analyzing a deal. Let's go back to the 8 full cycle, because I want to make sure my audience understands what that means. But again, going into this, you after you got the foundational knowledge, and again, we're not saying that you're 100% an expert, but you were dangerous enough and competent to be able to start picking out the things that aligned with you and the things that did not, which allow you to move forward with 3 syndication limited partnerships to begin with. What was the entry for that? Is that because I feel like there's this assumption, and maybe it is accurate. Is it always typical that it's 50K or 100K, or does it range differently?
So
Is it
a
could it be
normal
75?
limited partner investment
Yeah.
normally starts around 50.
Okay. Is that
Some
where you
deals
started?
50K for a passive investor.
So is that where you started?
Yeah, my first deal I actually invested 100,
Mhm.
and then my second deal I invested 50.
Okay, can you tell us again, because you have the knowledge, you've done like 20 of these. If someone's listening to this and like, well, I have 50K, but I don't have 100K yet. And again, I think I know what you're gonna say, but I'm curious because when we think of opportunity costs, is the opportunity cost of you not investing yet. So
Yeah.
do we know? Again, I don't have a model in front of me or anything, but you have 50K. Is it best that you put that money to work as soon as possible, or have you seen that? You know what, Ruben, when I put in 100K, that double effect, like we talked about,
Yeah, no,
it works further.
so again, if you had 100K, I would say put 50 in 2 deals. I just happen to have 100K and I decided to put it in 1 deal. That was my first one. But if I do a lot of times with investors, I got this much money. We had one deal, they had a 125K and they put 75 in one of mine, which is the minimum, 50 in the other. I'm always telling people that you want to keep it sort of simple as much as you can. And I hate to say it, but I only have a few minutes left because I have to get on another call. We went
Yeah.
pretty
No,
long here.
absolutely. No, this is great. But I think we're bringing it full circle. So I love the fact that you said, you 50K, you would actually split that up. Tell us about what does it mean to go full cycle when you say that, because we might not be well
Yeah,
aware of
so
what
when
that
you
means.
buy the asset, so it depends what you're doing. So let's say
Mhm.
multifamily, we buy it, we turn it around, it starts generating some cash flow.
Mhm.
So for example, a typical deal, you put $100,000 in, and I only use that because it makes the math simple for me. And you'll make about 30,000 in the 5 years on cash flow. which works out to probably around the 7-8%. And then when we sell the asset, your percentage of the proceeds would be about 70,000, which is where you double your money. So two things have to happen, right? You have to produce cash flow, and you have to be able to hit the NOI to be able to get the sales price to get that money on the sale. So that's
So you're
how
saying
you
that
would double your money.
you're saying the extra 70 is from the appreciation or whatever
That's
value add,
correct. Yes, the forced
you're also
appreciation, yes.
and you're also factoring in that you get 100K of the money that you had
The
initially
original,
invested.
yes.
Okay, very interesting. No, this is great. And what would that be like? You know, I know you talked about IRRs. Would that
So
be close
that's
to
about a
17?
that's about a 20% IR. It's about 18% IRR, and it's a 2 multiple of your money.
That's awesome. That's good stuff. See, I you know what I appreciated you coming in here today, Trevor, is you simplified it. I know I love how you use the babysitter. I love how you use the jockey. I think you're very well. You know, I could see why you're able to actually successfully bring in non-accredited investors into your world and essentially have them level up with you with massive capital. I think it's fascinating what you're doing here, and I'm glad you were able to step into the lab with us to share these insights. You know, you mentioned I think you're young in your career here. What's the you talk about helping 1,000 people. Is there a you know a goal that you have maybe financially, and or is there a certain amount of doors? What brings this whole full cycle thing full circle, for lack of better words?
Yeah, so for me, it's to be able to accumulate a personal net worth of about $10 million, to be, and that's just an arbitrary number, kind of set my own personal goal.
Good for
I
you.
think it will take me about 10 years to get there.
Yeah, I mean, yeah, I feel like there's definitely an opportunity based on your portfolio of seeing a hockey stick event. I don't know how that looks. I don't know if you at one point you start deploying more capital or you keep on dollar cost averaging and doing some of the same.
Yeah,
I'd love to hear more, but we'll have to have you back on the show for that.
awesome.
With
Yeah,
that said, Trevor, thank you so much for joining us today. How can
my
the people
pleasure.
be in touch with you? I know you mentioned LinkedIn, Trevor
Yeah, LinkedIn
Thompson.
is the best. They just got to remember the K, Trevor Thompson. Just tell me you saw me on your podcast, and I'll happy to connect.
Okay, Trevor Thompson, y'all, from Massive Capital. And just like that, we are out.
Awesome.
Hey, thank you, Trevor. I know you got to
Thank
run.
you.
Thank you. This was a good one. All right.
Yeah, very good.
Let
Thank
you
you
know when
so
it's
much.
out.
I'm glad we could do it.
Absolutely. Have a good rest of your evening.
Awesome.
Cheers.
Thank you. Take care.
Bye.
Experimentation. I believe there are two critical components that will help you achieve your goals very quickly and succeed. Number one, it's information like this that you received on a show, in an episode, and content that you can find on my YouTube channel or anybody's channel. And then there's a community. And the way we've been able to expedite our process, the way people in our community, people that we consult, mastermind members, whoever, they get the information on an episode like this, but then they also have the support, whether it's me guiding them or being guided through a community. There is an opportunity for you listening to be able to expedite your process or even expedite your results that you're seeking by being part of the community. If that is what you're interested in, we at Experiment Nation happen to have a community devoted to helping maximize your occupancy and your profitability altogether, regardless of which market that you are in. And for that reason, you have an opportunity where you can go to experimentrealestate.com/submit if you're looking to work in an environment that can help you prosper faster. Call out any areas that you might not be familiar in, especially the blind spots. That's where a guide comes in hand, and I would be a pleasure and honor to be your guide. But in order to make sure you're a good fit, make sure you go to experimentrealestate.com/submit so that my team can go ahead and take it and see if you're a good fit to join the mastermind and the multiple programs that we have. In addition to that, I'm also now a YouTube partner, which means that I want to give you more access to information, more access to Q&As, more access to the questions that actually come out of our mastermind to help people expedite the process. We've seen people get anywhere from $4,000 to $5,000 to $6,000 to even $7,000 a month net on just one door by applying the strategies that we use by working with corporations and furnished accommodation in a very strategic way. So if you're interested, make sure you also subscribe, because I'm going to have different tiers That's on YouTube now that we've become YouTube partner. To continue to be the bridge to your success in your lab, and your lab means your life, your goals, or wherever you're trying to head. So make sure you also hit the subscribe button on my YouTube channel. That's youtube.com/real estate experiment. We'll be there. You can also look us up at midterm rental insurance experiment. We will be there. Make sure you hit the subscribe, because that's when you'll know the tiers that are available to you that make sense for you, your marketplace, for your results. Remember, you're only one experiment away. Let's build.